Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to do a comprehensive review of the entire state of Texas, at least the top 4 metro areas in Houston, San Antonio, Austin, and Dallas. And some of the data points that we're going to review today: migration, unemployment, building permits, inventory growth, unaffordability, price decline, and price run up. And you guys, when I analyzed Texas, I can't tell you how amazed I was to find different patterns in Texas. So the really cool thing about this video is I'm going to tell you guys, of the things I just mentioned, what I believe are the main catalysts for continued price decline, at least here in the state of Texas. I really hope you guys enjoy this comprehensive review. But remember, I'm not a financial advisor, even though my bio is as a realtor of over a decade, and I am a realtor in Texas. I'm also a loan officer. I've been a loan officer for roughly 22 years. I'm also a CE instructor, so I live and breathe real estate. And I think you're going to find these data sets extremely important when it comes to understanding what exactly is going on in the housing market. There's no question Austin, Texas is leading the price crash in the United States. Yet we have other cities like Houston that barely have made a dent in the value overall. So I think it's going to be a great video because we have a lot to talk about, a lot of stuff to compare. So what I'll do is I'll take us through each data set and I'll talk about each 4 of those metro areas. But before I do that, let's talk about Texas as a whole as compared to the rest of the United States. I want to start by painting a picture of how Texas reacted to the last great financial collapse. You guys can see here, again, this is the Reventure app, but this is showing us how much decline Texas had during 2007 and 2012. And you guys can see that Texas only had a loss, an average loss of 5.3%, whereas California, 41%, Florida, 48%, Arizona, 49%, Nevada, 60%, Washington, 30%. So last time, Texas was relatively safe. Now, taking a look at the next data set, this is basically the unaffordability ratio, or the housing payment compared to the median income. You can see that on average, Texas is actually at 35.69%. Generally, we want that at about 25%. You can see that Texas is way far from that, but it's not as bad as some of the places on the West Coast, like California being at 61%, Washington at 50.43%. So although Texas isn't in the worst shape, it's still relatively unaffordable as a whole. Then we take a look at building permits, and we can see that Texas is the #1 state with building permits. And building permits aren't starts, it's not under construction, it's not inventory, it's essentially future projects. So there is no state with more future projects than Texas. And Texas is sitting at 240,000 permits being pulled, which again is #1, followed by Florida at 191,000 and California at 107,000. Now looking at home value according to Zillow year over year. So year over year, Texas is actually at 2.7%. And remember guys, it takes roughly 8% to sell your house, generally 8%. Just talking generally here, 6% to realtors, about 2% to junk fees. Now, if you purchased in Kansas on a year over year basis, you have about 1% of equity after you reduce fees, but Texas is right at 2.7%, whereas the West Coast is at massive losses, starting from Washington to Colorado, Arizona, and California, but Texas is still 2.7% year over year, despite Austin being completely gutted. Now, going into unemployment, you can see that Texas is actually at 4% unemployment. The national average right now is 3.7%. So overall, Florida is slightly above the national average of 3%, again, sitting at 4% as of April 2023. When we look at total migration as a percentage of the population, we can see that Texas is actually rated high at 1.21% of the population coming from migration. So that is super high. Obviously, #1 is Florida, followed by South Carolina, Montana, and Idaho. And I will note that this is a little bit behind. This is using the census data for 2022. Unfortunately, we don't have 2023 yet, but you can see overall, Texas is up there as far as migration into the state. I'm going to break down again Houston, San Antonio, Austin, and Dallas in that order. We're going to start with migration percentage. At the end of this, I'm going to have a conclusion on what data sets I think are driving the housing market. But when we look here, we can start with Houston. Now we can see that Houston is at 1.21%, which essentially is matching the state average of 1.21% as well. And I will note that Houston is the biggest metro area in Texas and the second biggest metro area in the entire US. Now, the number 2 metro area is San Antonio, number 7 in the entire United States. Now, San Antonio has a higher percentage of migration, which I found surprising. That's sitting at 1.64%, which is a lot more than the state's average. Now, take a look at this. When we go over to Austin, look at Austin, you guys. Austin is sitting at 2.12%. Not quite double, but 2.12% is huge. Now, obviously, Austin is not as big as Houston or San Antonio, but having 2.12% of your population coming from migration, that's a pretty big deal. Now here's Dallas. Dallas is sitting at a whopping 1.7% of the population from migration. So in conclusion here, Houston has the least dependence on migration, whereas Austin has the biggest dependence on migration. So it's kind of safe to assume the more dependence a metro area has on migration has a higher likelihood of instability in the housing market, especially if the migration stops or rather slows down. And I believe that's what we're seeing in Austin. Now let's go into unemployment. You guys are going to find this absolutely astonishing, my conclusion about unemployment, but I did want to say that Houston is actually at 4.3% and actually peaked, and I didn't know this, peaked in February at 5.1%. So unemployment is actually a lot higher than I originally thought. In Houston, it is obviously exceeding the national average of 3.7% and the state average of 4%. But Houston is sitting at 4.3% right now. Moving on to San Antonio, second largest metro area in Texas, 7th in the US, is actually sitting at 3.9%. So the 3.9%, slightly under the state average of 4%, slightly above the national average of 3.7%. I'm kind of surprised by all this, to be honest, guys. But I am really, really surprised by Austin because we know that Austin is leading the price crash around the US. However, the unemployment rate is only, you guys listen to me, as of April is only at 3%. So Austin has much lower unemployment rate than the statewide average and the national average as well, yet it's leading the housing market as far as price crash. What does that tell us exactly, y'all? Going into the last metro area here, Dallas. Dallas is actually sitting at the national average of 3.7% unemployment, which again is under the state average of 4%. So in conclusion, Houston actually has the highest unemployment rate. Austin actually has the lowest unemployment rates. I think you're going to find my conclusion at what the actual catalysts are very intriguing towards the end here. But let's move on to our next data set, which is year-over-year inventory growth. Obviously, inventory is a super important thing, but just how important is it? Which metro area has the most inventory growth and which metro area has the least inventory growth? So Houston is actually sitting at 55.9% inventory growth. That's down obviously historically, but as far as actual growth, that's a substantial growth. Unfortunately, again, you guys, the active units is only 17,137. Last April, it was only about 11,000. So pretty decent inventory growth in Houston, again at 55.9%. Now, when we go on over here to San Antonio, look at what we start to see. Year-over-year inventory growth, triple digits in San Antonio right now. Pretty astonishing, guys. So San Antonio actually has inventory growth year-over-year of 138% for a total active unit count of roughly 6,800 active units. That's up from about 2,800 last April. So substantial inventory growth in San Antonio. And odds are for the next couple years, so long as the quantitative tightening and the interest rates stay elevated, more than likely inventory growth will continue to skyrocket up, hopefully taking us back into a more balanced housing market. But massive inventory growth right now in San Antonio. Now take a look at Austin, which again is leading the housing market price crash. Austin, y'all, has a whopping year-over-year inventory growth. Are you guys ready for this? 258% So this may be one primary reason why we're seeing Austin continue to crash, whereas many other metro areas have been able to rebound through seasonality. And to put it in perspective, they have actually more active units than San Antonio, yet it's a bigger metro area. So Austin has 7,200 active units right now. Now that's up from last year of 2,000 units. So they went from 2,000 units, as you can see, all the way to 7,200 units, again, totaling a 258% inventory growth in Austin. And last but definitely not least, we have Dallas. Now, Dallas has an inventory growth of 130.9%. So we now have active units of 12,529 active units. That's up from 5,426. So if you're in Dallas, if you're impatient, understand that these cycles take time. More than likely, the longer that you wait, the more inventory options we will continue to have. So we have Austin at number 1, San Antonio at number 2, Dallas at number 3, and Houston at number 4 as far as inventory. So we would think because San Antonio's number 2 that they would be placed number 2 for price decline. But the reality is, and what you're about to find out the further we get on in this video, is it's not just inventory that matters. Let's move on now to building permits. So taking a look at building permits, starting with Houston. Again, this is not starts, this is not under construction, this is not inventory. These are future plans for new home builders to continue to build more homes. And Houston is sitting at right now, y'all, 71,000 building permits. Y'all, that's insane right now. That matches roughly where we were at in 2006. It actually exceeds it. That's insane. So the building permits right now are exceeding the peak of the last financial collapse. So a ton of building going on in Houston. I actually have probably 5 to 7 new home building communities within about a 15-mile radius of my house. So a ton of new building going on in Houston right now. Now, when we look at San Antonio has about 22,000 new permits being pulled, which to me is actually surprisingly low for being the second biggest metro area. I thought it would be much higher actually than 22,000. Now, when we go over to Austin is actually almost double San Antonio, which again, I find extremely surprising because Austin is technically a smaller metro area, but yet has double the new building permits, sitting at 41,000 permits. So I'm not saying inventory doesn't matter. Inventory absolutely matters, but there are other factors at play here as well. But regardless, we can see Austin not only has a significant amount of inventory growth, they also have a significant amount of permits and new construction going on as well. Now, when we go over to Dallas, we see a bunch more permits sitting at 72,255 permits, which is almost a historical high. The peak during the financial collapse was about 60,000. So they're at about 11,000 more permits compared to the peak of 2005. So almost historical high permits right now in Dallas. And I think you guys are going to find Dallas especially intriguing once we get to the conclusion of this video. So let's hop on over to Redfin Data Center right now to take a look at median sales price. Now, starting with Houston, you guys. So Houston currently, as of the week ending June 4th, is down 3% year over year. But again, you guys, add 8% to that if you wanted to sell, because it cost roughly 8%. Now, I want to point out that as of 2022 in Houston, the median sales price average ending May 31st was $248,000. That represents a growth of from 2020 to right now of 37.5%. But not only that, you guys, if we go from the peak right here, that is a total 2022 to peak run up of 40.5%. And this is an especially important data set to pay attention to, because what I have found is equity run up is actually one of the leading catalysts when it comes to price decline in Texas. Now take a look at San Antonio. San Antonio is only down -2% year over year, or more like 10% when we add the 8% to that. And that's as of week ending 6/4 of 2023. So it's down 2% year over year for a total median sales price of $330,000. When we compare to where we were at in 2020, week ending June 7th, you can see the median sales price was actually $243,000. That represents an equity run-up of 35.8%. When we calculate it based on peak numbers, it equals a 37.8% equity run-up in San Antonio. So now let's take a look at Austin. And the intriguing thing about Austin is actually under 2022 and 2021 median sales price, y'all. So there's no question in my mind, Austin is crashing. Now, it did rebound over the 15%. That is my definition of a crash. But this is through like seasonality uptrends. So more than likely when our seasonality downtrends come, it's going to spiral even more out of control. But right now, it's important to understand Austin is down 13% year over year. But again, when we add the 8%, the reality is that's 21%. And when we compare to where Austin was week ending June 7th of 2020, the median sales price was only $331,000. Now, right now it's $472,000, which means that is an equity run up of 41.7%. So that's how much juice or that's how much bubble is left in Austin when we compare from 2020. Now, from peak, Austin went up a whopping 54% in that short amount of time, you guys. 54% equity run up from peak Austin, and that's about 2.5 years. So Austin went up over 50% in equity in about 2.5 years. Insane, you guys. Absolutely insane. Now let's take a look at Dallas. And I'm actually a little bit surprised on what Dallas is at right now. I actually thought San Antonio would be worse off, but Dallas is actually much worse off than both San Antonio and Houston by almost triple. So you can see that the average median sales price in Dallas is $433,000. And y'all, that's down a whopping 7% year over year, or rather 15% when we count in the fees it takes to sell your house. The interesting thing is this as well. When we look at what the median sales price was in 2020, we can see it was $304,000. Now that represents an equity run-up of 42.4%, which exceeds Austin, you guys. So it is likely that Dallas can actually continue to go down at a faster pace than Austin because they have more juice to be squeezed out as far as negative equity. When we look at the peak, we'll notice that Dallas actually went up almost 50%, 49.4% from 2020 to peak. So in other words, Dallas is actually the number 2 metro area when it comes to excessive equity growth. Again, you guys, I didn't realize that. Everyone knew Austin, but I didn't know the number 2 metro area in Texas was actually Dallas. What role does massive equity run-up play on house prices going down? We're about to find out. But first, one more very important data set, which is basically the unaffordability data set. It's basically the average house payment divided by the median average household income. So let's see how unaffordable Houston, Austin, Dallas, San Antonio are. And remember, you guys, generally, we want this at 25%. Anything above 25% starts getting dangerous, especially when you start to get into the mid-30s. But starting at Houston, we can see that Houston is actually at 34.14% as far as the unaffordability ratio. So Houston above 25 by almost 10%. So it did get more unaffordable, obviously, y'all, in Houston. And if we look at historically, you can see that 2 years ago, y'all, just 2 years ago, it was at 19.4%. So it went from 19.4% to over 34%. Pretty shocking. Now, when we go over to San Antonio is actually very close to Houston. Unfortunately, again, over the 25% that we want, sitting at a whopping 36.52% in San Antonio. And again, if we go back to 2021, San Antonio was sitting at 20.5%. Talk about a flip-flop as far as unaffordability in San Antonio. Going over to Austin, we can see that Austin has a huge problem with unaffordability. Austin is actually sitting at, and this is pretty unheard of for Texas, y'all, 46.52%. So about half of people's income is going to paying off their mortgage. That is a horrible way to live life, y'all. You don't want half of your income going, probably more than that actually, going to paying off your mortgage. But again, Austin is sitting at a whopping 46.52%. Now back in 2021, okay, just to put this in perspective, Austin was only at 27.5%. It was almost at what we want, about 25%. So you guys can see for yourself, Austin had a massive run up in not only prices, but also unaffordability. So Dallas is actually sitting at almost 40%, whopping 40%, but they're technically sitting at 39.48%, which means that Dallas is actually the number 2 most unaffordable metro area in Texas. Again, that surprises me. I thought San Antonio would actually have taken the number 2 spot, but Dallas is. And again, let's take a look at what it was at in 2021. Dallas was only at 22.2% in 2021, so 2 years ago. So unaffordability essentially doubled in just 2 years in essentially all 4 of those metro areas. So I'm going to give you guys the top 4 catalysts that I believe are happening in Texas that are governing the price crashes. And I'm going to give you this list in order of importance. So the number 1 catalyst that I'm seeing in Texas as far as negative price growth is price run up. The more that prices actually ran up, the more likely it is that those metro areas will have a faster decline. Now, the number 2 thing is actually not inventory. The number 2 thing was affordability. The more unaffordable a metro area is, the more likely, again, it is to have additional price decline. Now, shockingly, number 3 is actually inventory. And I thought that that would actually be number 1. But when we again analyze this data, number 1 is the price run up. Number 2, unaffordability. But number 3 is actually inventory. Now, the fourth main factor, y'all, that I believe is hitting our housing market is migration. Now, I used a baseline of other metro areas to come to this conclusion, like Boise, Las Vegas, and Phoenix, so I can kind of analyze why their home prices are crashing. Now, one really interesting thing that I want to note here is so far, at least in Texas, it appears, okay, listen to me, that unemployment does not have a factor in home prices, at least the overall unemployment. And case in point is this: Houston has the highest unemployment rate at 4.3%. Yet they have the 3rd largest equity drop of only 3%. Austin has the lowest unemployment rate of 3%, and yet the price decline is the largest. So that data set right now is completely backwards. Until we see a substantial increase of unemployment, odds are that unemployment is not going to have a massive effect on the housing market. Obviously, that depends on what type of unemployment. Is it the high-paying jobs that are going through job loss, or is it like the low-paying jobs that are having job loss? So all of those things also matter. But when we also look at the West Coast states like San Jose, you'll see that San Jose, even though they have massive price crash, again, super low unemployment. So unemployment as of right now is not having an impact on the housing market. Summarizing the 4 metro areas, starting with Houston. Now, what we've noticed with Houston is Houston is the least dependent on migration. And perhaps that's one of the reasons why it has been relatively solid when compared to, again, Austin and Dallas. As far as inventory growth, Houston actually ranks number 4 with inventory growth. They ranked number 3 with price growth, number 4 with unaffordability, and number 4 with migration. But Houston is the number 3 worse off metro area. So you can see that Houston was the number 3 and number 4 of those 4 data sets. But overall, as far as price decline, it is sitting at number 3. Now, talking about San Antonio. Now, San Antonio is number 4 when it comes to price decline, sitting at only a loss of 2% year over year. San Antonio is ranking number 4 with price run up. So the price run-ups are actually matching exactly. And that's why I'm saying the leading catalyst, at least in Texas, appears to actually be price run-up, not inventory and not unemployment, which is really shocking to me. San Antonio is number 3 as far as unaffordability. San Antonio is actually number 3 with migration. So we can kind of tell that those 4 data points are especially important in Texas. Now let's talk about Austin. Now, Austin is number 1 on all data sets. So first of all, Austin is the number 1 metro area that is leading in price decline at sitting at negative 13%. But Austin is also the number 1 metro area with inventory growth, the number 1 metro area with price run up, the number 1 metro area of unaffordability, the number 1 metro area dependent on migration. So we can see that some of this data is actually matching up to the leading metro areas with price decline. So again, Number one, price run up. Number two, unaffordability. But I'm not saying that inventory doesn't matter. But let's now talk about Dallas. Now, Dallas is the number two leading metro area of price decline, sitting at a loss of negative 7%. It's also interesting to point out that not only is Dallas number two with negative equity loss, Dallas is also number two with price growth, and Dallas is also number two with unaffordability. So we can see price growth and unaffordability are matching almost exact as far as ranking negative price decline. However, inventory growth is actually number three, whereas migration is number two. In conclusion, y'all, I would say overall, probably when we look at all four metro areas, the safest metro areas is probably going to be Houston and San Antonio. Now, Houston, I am a little bit worried about because the unemployment rate is already over 4%. So although it's okay right now, Houston is at risk of additional price decline. And I think additional price decline in Houston will be led by any potential increase in unemployment. That's followed by San Antonio. Really surprising that the strongest metro areas have the highest unemployment. Isn't that shocking to you guys? So when all is said and done, there are many data points, many data sets that we need to review to really understand what's happening in our localized housing market. And I really hope you guys found this video incredibly helpful. Now, again, in my opinion, and from what I see, some of the best times to purchase is anytime between December and February. Now, obviously right now I'm telling people to be extra cautious because we are still in the cycle, okay? It takes time. And if the housing market is crashing like I think it is, remember this also, that can take as long as 5 years. And I understand how inflation works. And really what I'm saying is what we want in the housing market is deflation, okay? Not disinflation. We want deflation. Now, other than that, guys, shoot me a comment below, send me an email, let me know if you have any questions, and I really hope you guys got some new value, insights, and perspective. And if you're out there investing in real estate, you know I wish you luck, and I hope you win.